Imagine watching a hyper-growth healthcare stock plummet 15% in a single afternoon, crushed under the weight of a federal lawsuit. What would your first instinct be? For most people, it's to run for the exits. You'd assume the growth story is broken, that management is compromised, and that the downside from here is limitless. But what if I told you that while terrified retail investors were dumping their shares into the panic, the smart money, including the single largest asset manager on the entire planet, was quietly and aggressively buying up millions of those very same shares? Today, we are dissecting Hims & Hers Health, ticker HIMS, a high-flying telehealth disruptor that has quietly become one of the most volatile, polarizing, and downright dangerous battlegrounds on all of Wall Street. And I mean dangerous in a very specific way, because sitting underneath this stock right now is a 30% short interest, a coiled spring so tightly wound that it could either detonate this company or launch it into the stratosphere. So the real question is this: are we looking at a crumbling house of cards ready to collapse, or is this the single greatest buying opportunity of 2026 hiding in plain sight? Stick with me, because by the end of this breakdown, you'll understand exactly what the entire market is getting completely wrong. And listen, if you're the kind of investor who wants the truth behind the headlines instead of the recycled noise everyone else is repeating, do me one quick favor and hit that like and subscribe button right now. It genuinely helps this channel grow, and it makes sure you never miss a deep dive like this one. All right, let's get into it. To understand where this stock could possibly be going, we first have to look at what the consensus on Wall Street actually says about Hims right now. And honestly, it might surprise you. If you pull up the official analyst ratings today, you'll find a surprisingly cautious, almost timid stance. The current consensus sits at a flat hold. The analysts have pinned an average price target of $31.43 on the stock, which basically tells you they believe Hims is priced to perfection, with very little immediate upside left on the table. But here is the catch, and it's a big one. This recommendation status is officially marked as pending imminent catalyst resolution. In plain English, that means Wall Street is sitting on its hands, frozen, waiting for a massive regulatory or financial coin flip to resolve itself before they're willing to commit in either direction. At first glance, this looks like a straightforward, boring, low-upside hold story. But as you're about to see in just a moment, there is one massive fundamental shift happening under the hood of this company that makes that cautious consensus look almost laughably outdated. And that brings us directly to the wild, stomach-churning price action that has set up this entire opportunity. Take a close look at this. What you're looking at is something I like to call the heartbeat chart of Hims over the last few weeks, and I promise you this is not just random noise on a screen. This is a direct, unfiltered story of greed, of fear, and of outright institutional warfare. Rewind back to July 24th. The stock spiked violently on a wave of pure optimism after an FDA peptide advisory panel backed 6 out of 7 key compounds, essentially handing Hims a massive green light for its customized treatment plans. Investors were euphoric. But just 5 short days later, on July 29th, the hammer came crashing down. The FTC announced a major data-sharing lawsuit against Hims, accusing the company of sending sensitive user health data straight to social media platforms. And the result? A brutal, neck-snapping 14.73% crash, sending the stock plunging straight down to $25. Panic was absolutely everywhere. The chat rooms were screaming, the doomsayers were declaring the company dead. And yet, look at what happened next, because this is where it gets fascinating. In early August, the stock staged a spectacular 23.3% recovery, clawing its way back above $30 like nothing had ever happened. Here's where the story starts to get genuinely complicated, because this rapid rebound has created a massive rift among Wall Street's top analysts. And when I say the division on Hims is unprecedented, I am not exaggerating even a little. On the bearish end of the spectrum, you have Deutsche Bank sticking firmly to a strict no-moat thesis, slapping a sell target of $25 on the stock, arguing that the regulatory risks are simply far too high to justify the current multiple. But then, on the complete opposite side of the ring, you have Canaccord Genuity practically screaming buy, with a price target of $40, focusing entirely on the company's explosive operational growth. But here's the real kicker. The real jaw-dropper lies in the long-term fair value projection models. These models project the stock's fair value climbing above $100 by the year 2030. Let that sink in for a second. That represents a potential 300% return from where we sit today. So who on earth is right here? How can two teams of highly paid professional analysts look at the exact same company and arrive at conclusions that are worlds apart? To answer that, we have to look at the massive underlying forces pulling this company in two completely opposite directions. But before you get too bullish and start smashing that buy button, there's another layer to this, and it starts with a fundamental battle between explosive catalysts and existential risks. Welcome to what I call the fundamental force field. On one side, we have three explosive, high-margin growth catalysts. First, HIM's breakthrough GLP-1 compounding partnerships. Second, their aggressive campaign of international mergers and acquisitions. And third, their cutting-edge artificial intelligence tech integration. But on the other side of this field, casting a long shadow, we have three massive existential risks: the looming FTC data lawsuit, the rapidly rising cost of acquiring each new customer, and a mounting wave of shareholder class action investigations. Think of it like a tug of war where both sides are equally matched and pulling with everything they've got. If the bull case wins, HIMS becomes a genuine multi-bagger, the kind of stock people brag about owning years from now. But if the bear case wins, the entire marketing engine stalls out, the growth evaporates, and the company's hard-earned reputation is severely damaged. So which force is stronger? Let's lay out the bull case first, starting with the massive catalyst that is completely reshaping HIMS's entire revenue profile. The absolute crown jewel of the entire bullish thesis is HIMS's aggressive move into the weight loss space. And to understand why this matters so much, you have to understand the massive secular shift happening in the market right now. Employers across the country are dropping coverage for expensive obesity drugs because, frankly, the costs are simply shattering their budgets. And when that coverage disappears, where do those patients go? They flood straight into cash-pay telehealth platforms, wallets in hand. And HIMS has positioned itself absolutely perfectly to catch this tidal wave. Through their landmark Wegovy partnership with Novo Nordisk, they are now adding an astonishing 100,000-plus new weight loss subscribers every single month. Just stop and think about the sheer power of that recurring revenue for a moment. 100,000 people paying out of their own pocket, month after month after month. This is not some slow, sleepy, steady growth story. This is a hyper-scaling machine that is capturing market share at a pace that frankly borders on unbelievable. But that impressive number sounds even better once you look at how they are scaling this exact model across the entire globe. Because here's the thing, HIMS isn't just a domestic American player anymore, not by a long shot. They are aggressively expanding their footprint worldwide, headlined by their massive $1.15 billion Eucalyptus international acquisition. This single move handed them an immediate high-growth foothold in critical international markets like Australia and the United Kingdom, opening up entirely new pools of customers overnight. And back home, they aren't resting either. They are busy building an incredibly sticky product ecosystem that's designed to lock customers in for the long haul. They just launched their proprietary AI-native HERS Care app, a tool specifically engineered to automate and hyper-personalize customer care, driving customer retention through the absolute roof. And this is the genius of it. By weaving AI into the core of their service, HIMS can deliver instant automated support that keeps subscribers happily locked into their ecosystem, all without needing to hire an expensive army of human customer service reps. Higher margins, stickier customers, lower costs. It sounds like a dream. But before you run out and buy the stock on that dream alone, we have to look at what's happening underneath the surface, because the bear case is mounting a very serious defense. Here is where that beautiful bull story slams headfirst into a major speed bump. First and foremost, the FTC lawsuit is deadly serious. The government is alleging that HIMS unlawfully shared sensitive user health information with social media giants like Meta and Snap, all to optimize their advertising. Think about how damaging that is. This hasn't just bruised consumer trust in a company whose entire business is built on privacy and discretion. It has also triggered a mounting wave of shareholder class action investigations, digging into potential securities violations. But honestly, the legal drama isn't even what worries me the most. The operational risk is the real ticking time bomb here, and it goes by the name of runaway customer acquisition costs. Telehealth is a brutal, cutthroat, low barrier to entry business. New competitors pop up constantly. And that forces HIMS to spend more and more money on marketing just to keep the flow of new users coming in. Here's the nightmare scenario. If their cost to acquire each customer starts rising faster than the lifetime value that customer brings in, then their future profit margins get completely and utterly shredded. The whole model breaks. And that terrifying possibility brings us directly to the one question that reveals what the most powerful players on Wall Street are actually doing behind closed doors. Because when we dig into the smart money flow, we uncover a fascinating and revealing split in conviction. On the left side of the scale, we have heavy institutional accumulation. BlackRock, the largest asset manager in the entire world, has enormous conviction here, reporting a massive 11.9% beneficial stake in HIMS. Vanguard is right there behind them, disclosing a 5.01% passive position, and they're joined by buying pressure from heavyweights like UBS, CalPERS, and Amundi. But now flip over to the right side of the scale, because this is where it tips. We see insider distribution, and it's aggressive. The company's own insiders have been dumping their shares at an alarming rate, selling over $87 million worth of stock, compared to a measly $1.17 million in buys. That is a staggering imbalance. On top of that, First Trust Advisors recently trimmed their position by selling 87,063 shares. So who has it right here? Are the giant institutions seeing a long-term compounder they want to own for a decade? Or do the insiders, the people who know this company best, sense that the peak is already behind us? Well, the answer might just lie in a massive market anomaly that is quietly brewing in the short interest data. Take a hard look at this, because the short float pressure gauge on HIMS is absolutely screaming red hot. Right now, there is an eye-popping 30.07% short interest, with over 61.4 million shares sold short. Now, to give you some context on just how wild that is, in the world of finance, any short interest above 10% is already considered high. 20% is rare, but 30%, that is absolutely positively extreme. It means a massive portion of the entire market is actively, aggressively betting that HIMS stock is going to crash and burn. But here's the beautiful irony that those short sellers are trying not to think about. This exact situation creates an incredibly dangerous trap for them. When a stock is loaded with this much short interest, any, and I mean any, piece of positive news can trigger a violent, explosive short squeeze. Suddenly, all those short sellers are forced to scramble and buy back their shares to cover their mounting losses, and that buying frenzy sends the stock price rocketing vertically in a matter of hours, not days. It's like pouring gasoline everywhere and just waiting for someone to light a match. And as we head into next week's highly anticipated earnings report, the options market is pricing in the perfect trigger to strike that match. The options market is bracing itself for pure, unadulterated chaos next week. Right now, market makers are pricing in a massive plus or minus 14% expected move for the upcoming earnings week. Really think about the magnitude of that. A 14% move in either direction means this stock could easily swing by $4 or even $5 in a single trading day. That's the kind of move that makes or breaks portfolios. And when we peel back the layers and examine the option chain for the August 14th expiration, we spot something incredibly telling. We see massive, heavy clusters of call option open interest stacked up at key psychological price levels. There's a huge wall at the $31.50 strike, another major cluster at the $35 strike, and yet another at the $40 strike. What does that tell us? It tells us that retail traders and market makers alike are heavily positioned and betting on a big move to the upside, and that positioning could very well act as the ultimate match to ignite that 30% short interest fuel. But before we can even think about executing a trade, we absolutely must map out the exact technical levels where the bulls and the bears are going to fight for control. This right here is our technical battleground map, and it's essential you understand it. Right now, HIMS has established a critical resistance ceiling sitting at $32.40, and you can see it clearly on the chart. Every single time the stock tries to rally and punch through this level, sellers immediately step in and slap it back down. It's a wall. On the flip side, down below, we have an incredibly strong, major support zone carved out between $21.05 and $25.02. This support pocket represents the absolute floor for the stock, the zone where buyers have historically stepped in with real aggression to defend the price, exactly like they did during that recent FTC-induced sell-off. If you're serious about managing your risk, these two price zones are the most important numbers on your entire chart. Now, when we take that 30% short interest, combine it with the explosive options pricing, and layer in these precise technical levels, they all converge into one single explosive trade setup. I call this the convergence, and it's the heart of this entire thesis. Picture three ingredients coming together. First, we have that massive 30% short interest, and that represents the fuel. Second, we have that 14% options implied expected move, and that represents the catalyst. And third, we have that heavy wall of call option open interest pressing right up against the critical $32.40 resistance, and that represents the directional pressure. Now, when you pack heavy short positioning against immense option implied volatility, and then shove all of it right up against a major technical ceiling, you create an imminent high probability breakout or breakdown scenario. It's simple physics at this point. This coiled spring simply cannot stay compressed for much longer. Something has to give. And next week's earnings report is almost certainly going to be the event that releases all of this pent-up pressure at once. The good news is, we have built the exact setups to potentially profit from that explosion, no matter which direction it goes. So for those of you looking to capitalize on this short-term volatility, here is our first precise trade setup. If you're a short-term trader with a taste for volatility, Trade Blueprint A is designed specifically to capitalize on a potential earnings-induced short squeeze. The trigger for entry is a clear daily close above that $32.40 resistance level. Why does that matter? Because a confirmed close above that ceiling proves the bulls have finally broken through and are beginning to force those short sellers to cover their positions in a panic. That's your green light. But, and this is crucial, to protect yourself, you must set a strict stop loss on any failure to hold $30. I cannot stress this enough. If the stock breaks the breakout and slides back below 30, then the trade has failed, plain and simple, and you need to get out immediately and preserve your capital. As for the upside, our profit targets for this trade are to scale out of your position at $35 and then at $40, aligning perfectly with those massive August 14th call option clusters we identified earlier. This is a high-reward, fast-moving trade built specifically for the earnings volatility window. But what if you're not interested in the short-term game at all, and instead you want to build a rock-solid, long-term position in HIMS for the next 5 to 10 years? For the patient long-term investors out there, Trade Blueprint B is the ultimate wealth generation setup, and honestly, this is where the life-changing money tends to be made. The strategy here is beautifully simple. You ignore the near-term noise. You ignore the regulatory panic and the scary headlines, and instead, you accumulate shares aggressively down in that $21.05 to $25.02 technical support pocket. You buy while everyone else is fearful. Now, your risk management here is straightforward. Keep a close eye on the FTC and Meta lawsuit developments. If the FTC ultimately forces HIMS to restrict their data-driven marketing engine, that could genuinely slow down their customer acquisition, and you'll want to adjust your position size accordingly. But the ultimate target for this long-term strategy? A massive $100 plus price target by the year 2030. The core thesis is powerful and clear. HIMS is poised to completely dominate the enormous cash-pay telehealth migration being driven by the unstoppable GLP-1 weight loss boom. You buy the fear, you tune out the short-term noise, and you hold on tight for the massive long-term payoff. So let's get to the final verdict. Is HIMS stock a buy, a sell, or a hold today? And the honest answer is that it depends entirely on your time horizon and who you are as an investor. If you're a short-term trader, this is a tactical hold, patiently waiting until the stock breaks decisively above $32.40. But if you're a long-term investor with vision, this recent dip has arguably transformed HIMS into an unquestionable, high-conviction buy down in that support zone. The fundamentals are hyperscaling, the smart money is clearly accumulating, and the long-term potential is simply too massive to ignore. Now, before we wrap this up, I need to be crystal clear with you about something important. Everything I've shared in this video today is for educational and informational purposes only. I am not a licensed financial advisor, and nothing in this breakdown should ever be taken as personalized financial or investment advice. The stock market carries real risk, and you can absolutely lose money. Every single investment decision you make is your own responsibility. So please, always do your own thorough research and consider speaking with a qualified financial professional before putting a single dollar to work. With all of that said, I would genuinely love to hear where you stand on this one. So here's my question for you, and drop your answer in the comments below. If you had $10,000 to put to work right now, would you bet on that 30% short squeeze igniting and buy the breakout, or would you patiently wait for the fear to drive HIMS back down into the support zone before accumulating? I read every single comment, so let me know your strategy, and let's start a conversation. And if this deep dive gave you a fresh perspective or helped you see this stock in a whole new light, then please do me a solid and smash that like button and hit subscribe so you're the first to know the moment the next big opportunity like this one appears. Thank you so much for watching all the way through, and I'll see you in the very next one.